If you bought a buy-to-let property 18 months ago, you would probably pocket around £180 on average. That's after all your costs and your mortgage. Now, today, buying that same house, you will be pocketing £350 a month. That is an around 100% increase in your back pocket. Same house, same buyer, double the cash flow. And almost no one is talking about it because they are looking in the wrong direction and for the problems. In this video, I'm going to break down to you exactly what is good about buy-to-let right now and the 4 regions that you can invest in to make some money. If you are like lots of people in the UK at the moment, you think property is over, and in particular, you think buy-to-let is over. Rates are up. Landlords left because of the Section 24 tax rules. Landlords are leaving because of the Renters' Rights Bill. If you were watching the mainstream media, you would think it was an obituary to landlords and the buy-to-let market. And a lot of people that are watching this video have got some money and some savings and they don't know what to do with it, and they're thinking property is a bad option because everybody is telling me so. But very, very rarely do the headlines and the mainstream media show you actual data, which is hopefully what this channel is for. So whilst lots of people are saying rates are going up or have gone up, they are not showing you that actually rates have settled at a very nice between 4 and 4.5% for the average limited company buy-to-let mortgage. And as we've seen over the last sort of 5 or 6 years, that rents have continued to increase as there is a supply and demand issue, which actually means the gap, as in what you make in pounds and pence after mortgage and other costs and what you can make from your rent, and it's wider than it's ever been since 2014. So in this video, I am going to educate you a little bit about yield. I am going to show you exactly what the gap is, and I'm going to give you the 4 regions to invest in. So in this video, I'm going to do 4 things. 1, I'm going to show you some actual pounds and pence maths and see what you could be making on a buy-to-let at the moment. 2, I'm going to walk you through 4 regions that I think you should be investing in at the moment to make good rental yields. 3, I'm then going to explain what yield is because it's a terminology that is thrown about and not everybody knows what it means. And number 4, I'm going to be honest about what's going on and try and predict or have a little look into the future with what is going on in the global landscape right now. Right, so let's just go straight to some maths. Average UK buy-to-let property in 2026. The average purchase price is around £200,000. They are renting for around £1,300 a month on average, and the average buy-to-let mortgage is around 4.5%. That is your typical buy-to-let structure. What we look at in Size Property Academy is a little bit lower below that in terms of purchase prices, etc. But these numbers feel right to me. So if you were to buy a buy-to-let and you were to put 25% down on a 5-year fixed term mortgage at 4.5%, you'd be putting around £50,000 down, and the bank would give you the other £150,000. So as you go in, so every month you get your £1,300 rent that we have just discussed. Your mortgage on £150,000 lending at 4.5% is £562 a month. Your letting agent is around 10% a month if you are not going to self-manage. That takes about £130 out of that rent. Voids and small maintenance and repairs, which I would always put to one side, I'd leave £130 a month for that. And insurance at the moment is about £35 a month. So total outgoings is about £857 if you are running your property well. Total coming in, £1,300 as we've already mentioned. So your take-home cash flow is £443 before tax. Now, at the moment for a buy-to-let, that is really, really good. And if you get it right and you buy in the right areas, you will have a good tenant. You will have little to no maintenance, hopefully. The tenant will look after it and you'll have little to no hassle on that property. So £443, whilst isn't a life-changing amount each month, if you look at that over the year and you buy multiple properties and you have a compound effect on that, that is a really substantial amount of money that will add up. Now ignore that bit. So £443 per calendar month take home pre-tax. That is a really good amount for your average buy-to-let, and we're seeing that really regularly. We look between £400 to £500 a month for a net cash flow on a buy-to-let at the moment within Size Property Academy. So if we look at it as 5,300 of clean cash flow on that 50% deposit, just crudely speaking, we're not looking at the BRR strategy at this moment, we're just looking at rental income and rental outgoings. That is roughly 10% return on the money that you have put in the house. And that, again, is without any capital growth or any compound where we refinance and take some capital out of that property. I'm just filming. Okay, If we actually compare that to 18 months ago, rates were about 5.62%. So mortgage interest was looking at about 668 a month. So that was £126 more a month on your mortgage payments. Rents on the same house were anything from 200 to 100, and rents on the same house were anything from £100 to £200 a month lower. So you obviously had less coming in. So take home was around £180, not £443. So that is a huge difference. And if you are a sensible buy-to-let landlord and you have got multiple properties, as you should, and as you should look at building a good property portfolio, and if we could get to 5 buy-to-let properties, which is a really good number for a sort of semi-professional landlord that is looking to invest for their future, that is £25,000 a year in cash flow from a low maintenance portfolio where you do not have too much hassle. We're not looking at HMOs, we're not looking at serviced accommodation. These are low risk and low hassle assets. So that's not yields, that's not percentages, that is pounds in your bank account. Now, you'll hear yield mentioned a lot, you'll hear me mention yield a lot, and it's a figure that people love and hate at the same time, but it is a good snapshot and a good way to sort of measure up different properties and regions quickly. Yield is a number that is mentioned a lot, used a lot, and is a good and quick way of looking at different regions and comparing different properties and areas quickly. Now, it's gross yield that we tend to use the number for. There is a way of looking at net yield, but we look at gross yield quickly. Now, gross yield is total rent annually, gross, so there's no costs come off that, divided by the property price, so whatever value that property is, and then times it by 100 to get your percentage. So a £110,000 house in the northeast, for example, renting at £775 a month is £9,300 in the year, and that is 8.4% gross yield. As I mentioned, it does help you and let you compare 2 properties in 2 regions very quickly. But the reason, as I've mentioned, gross yield isn't always loved is, like we say, it is gross. There is no costs taken into account. And actually, it doesn't tell you what is really important on a spreadsheet, which is your bottom line, which is the pounds and pence that hit your bank account after all costs have been considered. So a high gross yield in an area that we wouldn't necessarily want to buy might mean that you've got a bad tenant, and the 12% gross yield is fantastic on paper, but if they're not paying you right and there's lots of expenditure, lots of hassle and lots of outgoings, it's not a good deal. A low yield in London, for example, might work for you in certain areas and in certain ways because of the capital growth. But again, if rates rise, you are not getting a pound in your bank account, and that is important. Cash flow is absolutely key when we are looking at the buy-to-let strategy. Why have rents risen and rates lowered at the same time? So firstly, landlords are selling. I don't need to tell you this again. 93,000 landlords left the market last year due to Section 24 tax reasons, which have been in play for a little while now, but it's starting to come out in the wash. They are selling because of the Renters' Right Bill, where they believe that it's becoming harder to become a landlord, so they are selling up their assets and moving out of the market. But as that happened, and landlords are leaving because they don't think it's worth it anymore to them, there are still tenants that need rental properties. So there's a whole video potentially to do on whether, as landlords sell, it goes to owner-occupiers, which lowers house prices and makes it more affordable to everyone. This, for me, isn't the case, because renting isn't all bad, and there are people that will always want to rent. There are people that always need to rent. There are people that are moving into areas. They have affordability issues. They've split up from their partners and they need somewhere to live in the short term. Like, buying is not the only option. It is not always the best option, and it's not for everybody. So for example, as these landlords are selling up, there are still lots of people that want to and need to rent. So we are having a supply issue, and we are still having the same demand, and therefore rental prices are increasing, and they continue to increase. Not at the same rate they were doing post-COVID, but they certainly are. And at the same time, swap rates and gilt rates have come down. Now, as I film this, we have the Iran war in the background, and gilt rates have risen to a bit of a high recently. But as I wrote the script for this video, gilt rates were fairly settled, swap rates were fairly settled for a little while. Hopefully the Iran war does come to an end, and there seems to be lots of noise that there will be a conclusion to it soon. But 5-year fixed rate mortgages were peaking at around 5.5–6%. Last year, they've now come down to 4.5%. So we've now got lower rates, we've now got increased rents, and for the same house, as we've mentioned when we've just done the pounds and pence maths, there is a bigger margin on that. The people that are selling their rental properties never ran it like a proper business, and that's for lots of reasons: age, time, accidental landlords, the people that are doing well in buy-to-lets and now running property as a business. So that all being said, and you have some data to back up your decisions, here are the 4 regions that I would be looking at to invest in at the moment. They're a nice mix of rental demand, a nice mix of yields, a nice mix of what will be rental income, and then also, which we've not really mentioned in this video, we probably won't, is some good capital growth. Currently, the Northeast has the strongest yields in the country. Now, the Northeast is a mixed bag of stock. You've got Sunderland, Middlesbrough, Hartlepool, County of Durham. Now, these will all give you a skewed view on yields, and there's some areas that I wouldn't invest in at all. So it's very, very town and city specific. But we'll just look at some overall figures, and then I'll probably give you a bit more of a deep dive into which cities and where we'd look to. But at the moment, £110,000 house, which is the average for the area, is renting at around £775 on average. So in a £775 rental income, we're looking at a mortgage at £82,500, which is 75% of £110,000. That's £309 a month. The agent takes 10%, which is £77. Voids and maintenance, £75. Insurance, £30. So total outgoings of £491, which gives you a take home of £284 in the Northeast area. So that's a £3,400 a year cash flow based on a £27,500 deposit on an average £110,000 house, as we've just mentioned. You've got cash on cash return about 12%, which is all okay. So in this region, the entry price is pretty low. I do think there's lots of opportunity, especially in around Newcastle and parts of Sunderland. I still think there's lots of industry, lots of opportunity, good commuter routes, good network, a good road and rail network to get up into Scotland and then even to go further down south as you need in the UK. There are big employees still in the likes of Nissan in the area. They've got a lot of NHS offices. There's a big logistics sector around Tyne. So we've got tenant demand that is consistent. You could get 12 to 14% gross rent in Sunderland and parts of Sunderland and even down to County Durham. But to be honest, I wouldn't touch those areas. They tend to be cheap areas with high tenant turnover that are going to cause you problems, and you're not going to get good capital growth in those areas. I'd stick to the edges of the cities that are going to have good capital growth, that are going to have that necessity for tenant growth and demand. One of my favourites at the moment, and there's a couple of my mentees that are having great success in this area, but the south of Wales, Newport, Swansea, either side of Cardiff, and then across into Bristol. I didn't know this, but I did find this out the other day. The toll was removed from the Severn Bridge around Bristol not so long ago, and that has helped people and seen people move into South Wales because they don't have to pay to commute across the bridge every day, which is a huge frictional cost for people moving into the area. We're looking in the area, and this is the sort of sweet spot that I look for, about £150,000 on average for a property. And we're looking to rent about £950 on average. These are nice numbers to me. These are the ones that I really like to look at. So if we do the maths, we've got a £950 rent, a mortgage at 4.5% on the 112,000, 75% loan to value on the 150,000. That's looking at about £422. The agent takes home £95. Voids and maintenance, we're looking at £125, and insurance £35. So total out £677. So take home is £273 a month. So that is about £3,500 a year take home on a £37,500 mortgage. And as again, I said it earlier in the video, this is if you were just to buy the property, nice and simple. The strategy that we always look for is to buy at discount, add value, so you would have less capital tied up in each individual property. And we're also not taking into factor capital growth. So even on a basic buy-to-let deal, it looks nice, and we can make it a lot better inside of Size Property Academy. As I've mentioned, Newport is an absolute gold because it's only about 20 minutes to Bristol and or Cardiff. So there is loads and loads of industry and employment. We've got massive employers like Admiral Insurance. We've got Newport Docks, and there's a lot of investment from America around that area too. Some serious regeneration going on in the area, massive expansion on the university. There is loads and loads going on in there. We've already seen a house price growth in Newport, and I think there is a lot more to come. As always in each area, you need to learn the postcodes a little bit, and you can't just pick any spot in Newport, but I'm seeing lots of positive deals coming out of Newport and across into Swansea too. South Wales is a good area to be investing in. Manchester is my favourite place to invest at the moment for 2 reasons. We are getting lots of good rental income because we have a huge demand in around the city, and we are also getting good capital growth. It is not the easiest area to invest in because lots of people are looking there, but there is so much potential, and I am really liking it. We're looking at about £180,000 for an average buy to let in and around the Manchester area, but we're renting that at about £1,150, £1,200 a month. So if we look at our numbers again, £1,150 in, mortgage at 4.5% on 135,000, based on the average price of 180,000, is £506 a month. Agent fees are £115 on this. Voids and repairs £115, insurance is £35, total out £771, and your take home is £379 a month. £4.5 on a £45,000 deposit, super clean, super simple, 10% per annum. But again, using the caveats that I have said before, we want to be buying at discount, adding value and recycling some capital. Also, if you are starting out in property, you could self-manage some of your buy-to-lets and get even more profit by not paying the agent too. So there are lots of ways of even extending that income to over £500 a month net. Previously in Manchester, got huge chances of capital growth. The area is just booming with investment. The city is absolutely brimming with employment. And anybody that lives within the M60 at the moment is seeing values going up on their property. I could list out everything that's going on in Manchester, but honestly, all you need to know is if you are starting to invest and you are in the Northwest, or you want some help in the Northwest and Manchester is absolutely key. My fourth and final spot to invest is the East Midlands. We are seeing a lot and have seen a lot of growth in the East Mids. Places like Derby, Nottingham, Leicester, all down that M4 corridor, lots of industry, lots of employment. There's airports, there are industrial warehouses, there are lots of places that need people, and there is a lot of demand for living in those properties. We are seeing, again, very similar to Swansea, Newport and Wales, is a £150,000 average rental property, £925 a month in terms of rental income. So the numbers are almost identical to what we were looking at in Newport. You could be looking at £283,300 net a month on your rental property. Again, on a £37,500 deposit, you have got a great bit of steady cash flow and you are seeing good returns on your cash and your money. And again, as always, as when I'm looking at data, as I'm looking at rental properties, these aren't speculative bets. These are cities with real growth, with real industry, with real employment. Places like Derby that have the Rolls-Royce plant, real big employers where people are going to need to live for a long period of time. You couple that with good schools, good areas to live in, and you are going to get high rental demand and you're going to get good capital growth. So everything you should always do in property should be driven by data. And hopefully, as I've gone through this video, you can see the data works. And I can't pick out a scenario for everybody in terms of how much money you might tie up and how much you've got saved and what else you're doing. But I can give some hard data across the board in terms of what looks good here today. I can say that we're looking good at per property, £400 net a month rent. And then if we compound that and work it out, buy, refurbish and refinance and continue to do that and move through and build a sensible property portfolio, you will be wealthy doing property. Now, I also said I would be honest about where we are in the market at the moment, and I can't just sit here and say all property is great and interest rates are great and the world's great, because it isn't at all time. Today those numbers work because the mortgage rate is about 4.5%, and at one point we were hoping it'd even be sub 4 quite regularly. And the reason I'm always looking at the rates is because it's important to your cash flow. On the average £200,000 property, which we used as the sort of benchmark at the beginning, 1% extra on your mortgage rate is £125 extra a month that you need to pay. So that is quite a lot out of your cash flow. The one thing that is obviously going to cause some disruption at the moment is the war in the Middle East. Brent oil has been sitting at around $90 a barrel. Not quite as scary as some of the headlines that the BBC have been making, where we're going to run out and oil's £150 a barrel, which has occasionally got up towards that way, but people have used that to scaremonger lots of people. And we have seen, of course, the fuel go up at the forecourts, and it will have a knock-on effect on a lot of things. Oil is directly linked to nearly everything. Transportation costs, and then that costs to put food into the supermarket. We need oil to get ourselves around the country. Higher inflation from higher oil prices makes the Bank of England nervous. It also makes the gilts market nervous. The gilts market is what the government borrow at. It is an important indicator that we always need to keep an eye on. The gilts market pretty much rule and run everything without it being the most obvious thing. The 10-year gilt rates were as high as 7% the other day, which is pretty high, I won't lie. If gilts hold, or if gilt rates hold at that level, mortgage rates are likely to increase. So it's May 2026 now, and if you are running your numbers at the moment, it is worth stress testing your deal at rates at 5.5% and even 6%, just in case things do continue to go the way that it's going. This also isn't pessimism, because it also might not happen, and it also there could be a resolution quite quickly. Prices could come down, everyone could be more settled, and we could continue with our interest rates lowering as they were doing pre-Iran war. However, a sensible investor always looks at multiple different scenarios. So it is always good to price in some risk and to see what your deal would look like stress tested at 5.5% and 6% lending rates. So what I'm going to tell you now is exactly what you should be looking for. 4 key points to get the right buy to let. If you've enjoyed this video so far, please like it, please subscribe, and please take one of the free items that I've given you in the comment section. It's a renting guide that you can tick your way through to make sure you're a good landlord, or your free 6-step checklist on how to start in property. Click on them, take them, use them, freebies, use them. So number 1, is the area in long-term demand? Are there jobs? Are there good commuter routes? Is it somewhere that someone's going to want to live for a long period of time and people are going to be fighting over the houses? There's not loads of them in the country, so look and do your research. Watch one of my previous videos on the 5 best areas to buy in property, or rewatch this video where hopefully you'll get some help on where to invest. Number 2, are you buying at the right price? If the average house price is £140,000 on the street and you need to do some work to it, are you being able to buy that house at discount? Are you negotiating a good discount so you can price in and make some margin every time you buy? Remember, you make money in property when you buy. Number 3, are you buying it in the right company structure? Are you buying it through a limited company and not your personal name? Are you doing it right? Have you got the right setup before you go and buy? And number 4, have you run the numbers properly? Have you stress tested? At the moment, it's about 4.5% lending rates. Have you stress tested them up to 6? And does it work in all markets? The best investors in property at the moment are the ones that do deals based on data, on decision, and not emotion. And that is what I preach about a lot, and hopefully you are getting from these videos. One thing I do want to conclude though is property definitely isn't dead, and the buy-to-let market definitely isn't. As I've said before, if you build and scale sensibly, you can make some great money in property. Property is an investment strategy that should help you and your family create wealth for the future. But as for anything, it is scary if you don't know, and if you watch the mainstream media, it can be very, very scary. If you need some help in starting, book a free consultation call below, and we can look to help you buy your first buy-to-let if you've got some savings sat there. If not, I will see you in the next video.